Hello everyone and welcome to our anti-money laundering webinar on firm-wide risk assessments. We want this session to be as interactive as possible, so if you have any questions, please do submit them using the question link below. You can either submit them using your name or you can do so anonymously, and we'll try our best to answer each question throughout the webinar. Just to let you know, a recording of this webinar will be available on the resources page, and so will the slides, so please feel free to share these with your colleagues. I'm here today with AML team managers Susanna Eaton and Kathy Kalia-Holner, who will be talking you through the firm-wide risk assessment template.
Good afternoon, everyone, and thank you so much for joining us today for this session on anti-money laundering firm-wide risk assessments. So in this webinar, we will focus on two things. First of all, providing some tips and information on completing an AML firm-wide risk assessment, and we will then work through some examples of how you might use and adapt the template we have published on our website. So before Susanna and I go into the detail, I wanted to cover off some of the basics first of all. So most of you will, of course, know that all firms in scope must have a firm-wide risk assessment in place under Regulation 18 of the regulations. And this has been a requirement for a while, namely since 2017. So the risk assessment must be appropriate to size the nature of your firm and take into account several things, including information that we publish, and in particular our sectoral firm-wide risk assessment, and then also the 5 risk factors set out in the money laundering regulations, namely your firm's customers, the countries or geographic areas in which you operate, the products or services which your firm provides, your firm's transactions, and finally how your firm's products and services are delivered, in other words, your delivery channels. So the purpose of a firm-wide risk assessment is to help you identify the money laundering risks your firm is or could be exposed to, and consider how any risks could be mitigated through appropriate policies, controls and procedures. So having one will very much help you take a risk-based approach to preventing money laundering, and will also help fee earners when assessing risk at client and matter level. And it's very difficult to get client and matter risk assessments right if you don't have a firm-wide risk assessment in place. So also briefly wanted to mention Regulation 18 of the regulations, which requires you as firms to identify the risk of proliferation financing to your business. And this assessment can be done either separately or within your AML firm-wide risk assessment. So to cover off briefly of what we are seeing in our own work, so we obviously review firm-wide risk assessments as part of our on-site inspections and as part of our desk-based reviews. And we have found that most firms now do have a firm-wide risk assessment in place, which is great to see. And we have seen an improvement over the years, as you might have read in our recent Regulation 46 report, which was published in October of last year. Having said that, we are still coming across firms who don't have one in place and only do so once we write to them as part of an inspection or a desk-based review. And we also still see a lot of firms that use templates that have not been sufficiently tailored. And as we've said before, we have no issue with the use of templates so long as they are tailored to your firm and expand sufficiently on any risks identified. And Susanna will pick up on that point a little later on. So before looking at the various risks and some of the examples we have put together, I wanted to briefly mention our guidance and the various templates that are available on our website for you to use, which includes a useful checklist, which we hope will assist you in putting together a compliant risk assessment. And if you haven't already looked at those, I'd very much encourage you to have a read of them. So starting off then with the first of the 5 risk factors, which is client risk. So when assessing client risk, you'll need to consider various questions, such as, for example, what types of clients does your firm instruct? You know, are we talking about individuals, companies, the likes of listed entities, charities? Those are just a couple of examples. And then you may also wish to set out things like the percentage of those different types of entities that you work for, so that you can then get a better overview of your overall risk exposure. You may want to consider if there is anything about your client profile that makes these clients higher risk. So, for example, are any of your clients high net worth individuals, or politically exposed persons, for example, so that you can then consider what mitigation you need to put in place at file level to ensure that you are carrying out adequate due diligence checks on those types of clients. I would then look at the countries to which your clients have connections or business relationships with. Things like, are they mainly linked to the local area, or have they got any connections to high-risk third countries, for example? So this can include clients which are based in countries which are sanctioned, and you will need to consider your exposure to financial sanctions breaches here as well. And just to flag, we have recently published some guidance on how to assess sanctions risk at firm level, which you may wish to consider when assessing sanctions risk. So before I talk through some examples that we have come across in our work, I wanted to start off by saying that we have focused our examples today on the completion of the first box of our template. And it's obviously really important when completing or doing your firm-wide risk assessment in practice that all necessary information is included in there, including controls in place to mitigate risks identified, and that you then tailor these to your firm. So looking then at the first of the examples above, so all of this information that's set out there was included in one section of the firm-wide risk assessment that I reviewed. It is quite detailed, as you can see, and does tell us a lot about the firm's client base, which is really good. We can see how the majority of this firm's work comes to them, what types of clients they have, things like typical funding sources and details of their client turnover. And it's really good practice to set out knowledge of your client base's variance in wealth and sort of typical funding sources that you come across, as has been set out in that example. And it's also good to consider how clients are referred to your firm and how you get your work essentially. So it's important then to set out what controls you have in place based on the risk that you've identified. And I have added some information in this slide based on the example that we just mentioned. So this firm here has determined that all work they do is in scope, and they carry out identification and verification on all of their clients as a result. So they talked about the customer due diligence checks that they do, and mitigation might include things like taking steps to authenticate a client's claim of identity, or ensuring that robust measures are in place to establish ultimate beneficial ownership. The next slide then sets out some more controls and mitigation points. So you can see the firm have set out that staff all receive anti-money laundering training so that they are in a position to identify money laundering risk or money laundering, as it may be. The firm have then set out that they carry out client and matter risk assessments at file level. They talk about developing good relationships with clients so that they know when something isn't as it should be, or when something is off. And they then carry out also further checks when they act on transactional matters. So moving on then, here we have some further examples of information we have seen firms use to cover a particular risk factor. The first here being PEPs, or politically exposed persons. Now, the example I wanted to use, first of all, was politically exposed persons, because we come across this quite a lot, where a firm will fill out this section and then they will leave all the other boxes blank. So where that happens, we wouldn't consider this as being compliant, as insufficient information on that particular risk factor hasn't been included. So what we want to see there is whether you do act for any politically exposed persons, and what controls you have in place to ensure that these are identified as early as possible, and that enhanced due diligence will be carried out in such circumstances, which obviously, we're talking about PEPs, that must include source of funds as well as source of wealth checks. So again, with the next example on high net worth individuals, we can see that the firm have some clients that fit within this category, with some owning cash intensive businesses. And we would expect the firm to consider this risk in a bit more detail, potentially setting out who these clients are so that fee earners then can easily identify them. And we would then expect to see detail of the controls you have in place to mitigate the risk identified with this type of client base. So moving on then to some more examples of client risk factors that we come across. We do often come across cases where firms use a template which includes sort of pre-populated risk factors. So where a risk factor does not apply to them, some firms will simply write not applicable. Now, it's important to remember that the purpose of a firm-wide risk assessment is to assess the risks that you are or could be exposed to, as opposed to the risks that you're not exposed to. So if there are any risk factors that don't apply to you as a firm based on your work, I'd recommend removing that from your document. Wanted to pick up then briefly the point regarding acting for designated persons, which are of course individuals or bodies that are subject to sanctions. So we do come across this a lot where firms simply say they would never act for a designated person. And this is something that firms really need to be quite careful with, simply because the sanctions regime is obviously one of strict liability. So it's really important that you consider this risk thoroughly, either as part of your general AML firm-wide risk assessment or in a separate sanctions risk assessment, and that you set out what controls you have in place to mitigate any potential risks. So the final example then on high-risk jurisdictions. So when you are setting out that clients have links to high-risk jurisdictions, it's really important that you set out what these jurisdictions are. So for example, we often see firms set out the geographical areas where clients are based, such as, for example, the EU. So the difficulty with that is that not all EU countries have the same risk profile for money laundering purposes. So for example, Croatia, currently on the list of high-risk third countries. So if this firm's clients were based in that country, for example, fee earners might miss this point when assessing risk at file level and may not apply enhanced due diligence as they should if that hasn't been identified by the firm. Malta, another example of an EU country that was previously on the list of high-risk third countries. So my point is it's really important to identify the specific countries your clients have links to so that you can then consider and put in place controls to mitigate the risks of acting for such clients. Moving on to geographic risk then. So we want to know that you are essentially identifying and have put in place controls when acting for clients in high-risk jurisdictions or where transactions or assets are linked to high-risk jurisdictions. So points that you may wish to consider in this risk category includes things like, where does your firm operate, and where do you provide services to? So if you are, for example, an international law firm with offices across the world, we want to see detail of where these offices are, where they're based, and the risks this exposes you to based on the services you offer in those jurisdictions. So if you do operate outside the UK, do you operate in jurisdictions with anti-money laundering regulations and controls that are not equivalent to the UK? Some other things to consider, is there any work referred from jurisdictions outside the UK, or if you provide services to clients based outside the UK? And think about whether you have a process in place for assessing geographic risks generally. So it's really good practice to use reputable sources of information. Some of these you might have heard of: Transparency International, Basel, and obviously the Financial Action Task Force. You could use a combination of these as well if you wanted to sort of determine country risk. And it's also good practice to have a system in place for identifying high-risk third countries, which does not need constant updating. So looking then at some examples of text we have come across during our reviews under geographic risk. So we want to see, like I said, in this section, where your clients are based or have connections to. So looking at the first line in the slide there, we can see that this firm's clients are mostly local, but that 15% are international. So as we picked up previously under client risk, setting out that clients are international or based in a particular geographic region of the world is not useful when it comes to money laundering risk necessarily, because it misses any sense of the different risks posed by different countries. So we would expect firms to set out the names of the countries where the clients reside in this for this 15% that the firm have mentioned, and the controls that they have in place to mitigate against the identified risks. So with the examples at lines 2 and 3 there, be careful with making unrealistic statements in your risk assessment, or saying that you would never act for a client in a country that, for example, where there are significant levels of corruption. We do see this quite a lot, and it's important that you do set out controls, the controls that you have in place to ensure you identify such countries where they do arise. So the fourth line helpfully sets out that the firm have some clients in 2 high-risk third countries and the due diligence that must be applied to those clients. And the final line in the slide there then talks about whether the firm deals with countries with stringent currency controls, but I can see that there's no further detail added there, which is actually really important. And within that sort of section, I would expect to see more information on which country or countries the firm is referring to. So what the controls are in those, and what the currency controls are in those countries, and what processes the firm has in place to mitigate against any risks here. That's all for me for now. I'll now hand you over to Susanna, who will talk you through the remaining risk factors along with some hints and tips on your AML firm-wide risk assessment.
Okay, so thank you for that, Kathy. So I'm going to have a look at the products and services risk in a little bit more detail. This is actually an area that firms actually really struggle to get right. And we do see a number of risk assessments that really don't sort of address all the services that you provide. Often when we are doing an inspection or a desk-based review, we will have a look on your website, see what sort of services you're advertising on there, and also look at the services you've told us you're providing, and then we like to see them in your firm-wide risk assessment. So to put this simply, this section should really sort of describe the granular specific details offered within each area of law. We've seen some firms speak to department heads to get really sort of specific tailored information on what they actually offer within their teams. So if you do have different departments, then absolutely consider doing something like that. So let's have a look, let's take a deeper dive into this section here on the next slide. So first of all, client accounts. We see this all the time on templates. The majority of you will have client accounts, so it is important that you assess the risks associated with this. I'm really pleased to see this firm have gone into a little bit more granular detail when it comes to the conveyancing. They've acknowledged they do residential and also commercial conveyancing, and they have gone into the, purchases and sales, the lease extensions, landlord and tenant, that type of thing. Tax mitigation strategies. They have acknowledged that they will provide advice on SDLT. However, this is only general advice and doesn't actually bring them into scope of tax advisor. But it's really good to see that they have acknowledged that and highlighted that. So on to the next slide. Again, creating and managing companies. This is standard wording in template. I really want to see a little bit more granular detail here. What does that look like? Tell me a little bit about that, Again, wills and probates, more granular detail needed here, estate planning, that type of thing. Family, they have gone into a bit more detail here, and they've actually documented out everything they do within that team. And I think actually this is a really important time to remember that you really need to consider the interaction between work regulated and work that isn't regulated. So, for example, a personal injury claim wouldn't necessarily fall in scope of the regulations. However, if the damages awarded were to be held on trust, then this would absolutely bring the matter into scope. Proliferation financing, relatively new, but actually really pleased to see the majority of firms are acknowledging this and actually assessing the risk their firms face regarding this. So let's have a look at transactions now. So when I see your firm-wide risk assessment, I want to see all the transaction types that you do. And this isn't just the monetary transactions, but I also want to see, are you buying, selling shares, that type of things. I want to understand, what is a typical transaction for you? What is the size? What is the frequency? If you are dealing with complex transactions to your firm, then what mitigating factors are you putting in place? So let's have a look. Let's take a deeper dive into this firm's firm-wide risk assessment. I really do like the first page here. So the firm have spoken about, they deal with sort of clients that are relative to the firm. Property prices are sort of relative to the West Yorkshire area where they're based. They've detailed some information on their professional indemnity insurance, and actually I am aware that a lot of firms do provide quite a lot of information on their transactions to their insurers, so it's a really good idea to pull as much information out of there and put it in your firm-wide risk assessment. They've documented here their average transaction, highlighted any sort of high risk transactions that they've done in that particular reporting period. And, they've said here anything over 600,000 would be classed as high risk to their particular firm. That will differ depending on what size firm you are, depending on where you're based. Your risks will be very different. But I like how they've tailored the transaction risk here. They've also said that the majority of their conveyancing clients do purchase properties with a mortgage, although they have acknowledged some are also cash buyers. So let's have a look at the next page on transaction risk. So cash. Firms are still dealing with cash, although this is much lower than it has been. This firm will accept a maximum of £300. One thing I will say is do make sure your policies reflect this. We often see policy saying, well, actually, we will accept £500, which is then different to what might be in the firm-wide risk assessment. Interestingly, this firm have acknowledged that there might be clients, and you might have clients like this, who, due to perhaps being high profile, or perhaps the transaction, the matter is quite high profile, they want to retain an element of anonymity, secrecy. If you do act for clients like that, do document it down, do document the controls you have in place and also the rationale behind it. This firm don't do that, and they don't want to act for people like that. So I would say they could actually remove that totally from their firm-wide risk assessment. So moving on to the next slide, this firm have recently implemented an online payment system. We are seeing firms increasingly using technology in their sort of way of working. Again, I would expect to see some really good sort of mitigating factors here, some really good strong controls. You certainly don't want me putting £100,000 into your account using your online payment system and then calling you tomorrow asking for it back. So I like this firm have detailed where they will receive funds from third parties, and quite frequently that will happen, and quite frequently that is okay. So they have acknowledged here that if they're acting in probate, they might be collecting estate assets such as investment funds and such like. And conveyancing, it's quite normal to be receiving gifts from family members, friends, and they've also documented here the payment types that they do receive, these being cash, cheques and card payments. So actually, on the whole, I think this is a pretty good section. I think they could go into a little bit more granular detail, but having a look at that, I can really see what's the norm, what's a normal transaction for this firm. So let's have a look at the next slide, which is delivery channels. So funnily enough, I think people initially think delivery channels is quite easy, and we see a lot of firms that purely say face-to-face or non-face-to-face, but actually we want to see a lot more detail. So a good place to start is by describing the means by which you deal with your clients. So, face-to-face, absolutely. Telephone calls, emails, video calls, that type of thing. But delivery channels isn't just about, how you communicate with your clients. It also does include any instructions you receive from third parties. So is a family member instructing you? Is the secretary of a CEO from a big corporate instructing you? Is a broker instructing you? How do you ensure that these are genuine instructions and actually the third party does have authority to act? Your delivery channel section should also reflect on whether you actually receive or send funds from third parties. When would it be appropriate to do so? And, of course, what are the risks associated with doing this? So let's have a look at what this firm have put in their firm-wide risk assessment. So they have acknowledged these particular ways of communicating, but again, I want to see some really good mitigating factors. I want to see some controls. What happens if the emails are intercepted, that type of thing. Telephone calls, how do you know you are talking to your client? This firm have recently implemented an online messaging portal on their website. So again, I would like to know what sort of controls you're putting in place. How do you know who the person is on the other end of the computer? What information are you sharing on your online messaging portal? Disappointingly, this firm haven't actually reviewed their exposure to passporting, which I would expect to see in the majority of firms. So this is where a client will instruct a firm on a particularly low risk matter, perhaps it's out of scope, to then avoid scrutiny later on. This does remain a primary concern as referenced in our sectorial risk assessment. So delivery channel risks, this section I'm not too impressed with, and in my view, it would only be partially compliant. So that's it for our sort of firm-wide risk assessment. And I'm now going to go on to some hints and tips. So firstly, your firm-wide risk assessment must be easy to identify. The LSAG guidance is very clear that it should be a distinct document. We do still see firm-wide risk assessments that have been incorporated into another document, such as your AML policy. And actually, it can be really difficult to tell where your firm-wide risk assessment starts, where it ends, and actually, that might be the same for your staff. We consider it good practice to detail the methodology that you've used in preparing your document. So, this could be talking to heads of departments, it could be reviewing the national risk assessment, LSAG, that type of thing. And by sort of documenting this, it really does evidence that you have complied with the requirements in Regulation 18. Thirdly, expand on the risks identified. What is usual for your firm? What is considered unusual? Every section should clearly demonstrate that you took time to consider everything. If you're going to use a template, which, as Kathy said, we don't mind you using a template, but you really must not completely rely on standardized text or sort of just tick pre-populated boxes or write NA with no explanation. A good firm-wide risk assessment should tell me what the firm does and not what you don't do. If there's information in a template that is just not relevant to you, then delete it out. You don't need it in there. So my next tip is a reminder that your firm-wide risk assessment is a living and breathing document. You should be reviewing it regularly. You should be ensuring that it does sort of remain accurate, up to date, and it also does identify any emerging risks. We still unfortunately see firm-wide risk assessments that do contain out-of-date references, out-of-date names, that type of thing. So really make sure that it is an accurate reflection of your firm today. It probably does go without saying that it should be signed and dated by the responsible person, so there really is no confusion in the future about when it was last reviewed. And do keep previous copies of the document so you can demonstrate continued compliance. When we are doing inspections and desk-based reviews, we may ask for copies dating back to 2017. So it's really important you do retain those copies for us to see if need be. Lastly, how you choose to rate your risks is up to you, but please do keep the terminology simple. High, low, medium, 1, 2, 3 would absolutely be sufficient. You know, there really is no need to overcomplicate weighting matrix. It's really not necessary. Make it a user-friendly, easy read for your staff and for anyone else who might read it. And I think actually lastly, I will just say that if you disagree with any pre-populated ratings on templates, you know, remove them. But just to say, please, please, please tailor any templates to your firm. Make it really specific to you. So my last slide, it's just some helpful resources. Have a look on our website. We've got a great template on there. We've got some really good guidance on there. We have a checklist. We have questions you should ask yourself, you know, questions you should ask yourself when completing it. And there's also a link here. So please click on it. And I'm now going to pass you back to Mandeep for some questions. Thank you.
Thanks, Susanna and Kathy. Just to let you all know, the slides will be available to download on our events on demand page, and so will a recording of this webinar be available. We've had quite a few questions in, so now moving into some of the Q&A. So Kathy, first one I'll send your way. Do I need to use the SRA template or another template generally to put together my firm-wide risk assessment?
So whether you use our template or any other template for that matter is entirely up to you. So based on what I have seen, some firms do find templates useful in helping to sort of get to grips with the money laundering requirements and the various risk factors. We have, of course, released a template, which we've mentioned a few times now on our website, to assist you in the completion of your risk assessment, should you wish to use it. And we have recently actually updated that as well. So if you do use a template, the most important thing, and I think we've said this already, is that you make sure you tailor it to your practice, to your firm, as much as you can. So in many cases, we have found that the risk assessment did not match a firm's profile and did not at all reflect the risks from its services and sort of client demographic. The money laundering regulations are really clear that you must carry out a risk assessment, which is relevant to the size and nature of your actual business. And you as the firm will be very much the expert on that point. And also remember, just want to mention that you cannot pass off the sort of the regulatory risk or burden of non-compliance to a third party. So for example, if you are using a consultancy and they give you the wrong advice, or they complete the firm-wide risk assessment template for you, and this document turns out to be non-compliant, the responsibility remains with you. And I have seen this happen in practice, so just bear this in mind when you are using templates.
Great, another question in. I'm a small firm. How much detail should I have to go into? Susanna, I'll give that one to you.
I think Kathy touched on this earlier. You know, it should be size and nature. It should be proportionate to your firm, but ultimately you do have to follow the regulations. I would, if you are a small firm, I would utilise as much information as you can that we have on our website. And absolutely, it will be much smaller compared to a sort of, you know, a larger firm. But no, absolutely, you still need one. But size and nature, absolutely, you know, we will consider that and be pragmatic with that.
Thanks, Susanna. Another question that we've had in, meeting clients virtually is becoming more and more common. If this is the new normal, would it still be possible to, would this still be a risk for the purposes of the firm-wide risk assessment? One for you, Kathy.
So I do agree that for many firms, seeing clients virtually is now the new normal, certainly post-COVID, and we have seen an increase in this. So off the back of that, I would say that not meeting a client face-to-face is no longer an automatic risk in itself. But I think it's important to remember that's still something you should flag as a potential risk in the first stage of your firm-wide risk assessment, because this particular risk combined with potential other red flags or risks might mean that you consider the AML risk attached to a particular client to be higher in that instance. So if we consider, for example, how we would deal with this in a firm-wide risk assessment, you might highlight that there are clients you haven't met, and there could be a risk attached to that. So, for example, they could be hiding who they really are, but your mitigations may then set out that you've met them on screen, for example, and that a lot of firms are using Teams and Zoom, and that you've asked them for identification on screen. You could ask them to sort of hold up their passport to confirm it's them that you're speaking to, and then you could then, off the back of that, consider whether there are any other sort of risks or red flags that heighten your risk assessment, and whether there is a need for additional scrutiny in that case. And yeah, I mean, your firm-wide risk assessment is really where you set out all of your thought processes and the actions that you'll take off the back of that, I would say.
Right, thanks, Kathy. One for you, Susanna. How frequently should I update my firm-wide risk assessment?
I think probably as and when required. You know, you will know your firms, you will know changes that are happening within your firms. I would have said at least annually, but you know, very much a living and breathing document. You know, and just keep it up to date, regularly review it, perhaps quarterly, formal review, at least annually, but as and when.
Great. We've had a question in from Sarah Chrisman. So one for you, Susanna. Does the firm-wide risk assessment require firm-wide participation, or can it be completed by a knowledgeable second-line person?
I think it actually would be great to get firm-wide participation in. I think, you know, not everyone's sort of experts across the law. So if you can sort of reach out to different departments, absolutely use their knowledge, use their information. It really helps in making a tailored you know, firm-wide risk assessment. You know, ultimately the person responsible will have to sort of review it and sign off. But absolutely, I think, you know, it can be completed by, you know, as many people in the know as possible, as long as the ultimate sign off is the person responsible.
Great, and it's another one in from Sarah. Kathy, so I'll come to you with this one. What would be best practice to structure the assessment to maximise first-line contribution?
So I think reiterating what Susanna said, I think really it's up to you as a firm to decide how you want to gather the information as part of your sort of your information gathering steps. I mean, the first step you need to sort of take when completing your firm-wide risk assessment is identifying those risks, and it's really up to you to decide where you go to get that, to ensure that you know you have all the different information about the areas of the business, your clients, and the markets that you serve. And I think very much for me then depends on sort of the size of the firm, but if we're talking first line of defence, I think we're probably talking about a larger firm here. So in which case I think, you know, the more information you can get, the better really, because it'll just ensure that your document is more sort of rounded, has more information in it. So absolutely, I would say that would be a really good move.
Great, and then one for you, Susanna, from Mamuna. How often should firms be reviewing and updating their firm-wide risk assessment?
I think as we said, you know, as and when things change. So, you know, are you implementing some new technology? Are you sort of branching out to a different area of law, that type of thing? So as and when you know your firms, you know what's changing. So keep it up to date.
Great. And we've had an anonymous question in. How do you know if a country doesn't have equivalent AML rules to the UK? Is there a list? So I'm happy to take this one. We did have Schedule 3ZA in the money laundering regulations, which has recently changed now. High risk third country list, what we now do is look at the FATF list of increased monitoring. So that's what you would rely on. But throughout the webinar, Kathy's referred to other sources such as Transparency International and the Basel Index. So we can link those to the resources page after this webinar. Great, and we've had another question on PEPs. So if a firm have never acted for a politically exposed person, would the SRA expect the firm to remove this completely? I would have thought you would expect to see something along the lines of aware of the risks for acting PEPs. We check for PEP status, but we have never acted for a PEP. Could you please clarify? So Susanna, I'll come to you with this one.
I think you're absolutely right. You don't know if tomorrow you're going to have a PEP walk in. You don't know if actually a client, a current client of yours is suddenly going to become a PEP tomorrow, or an RCA, a relative or close associate. So no, absolutely. I think a PEP is something you should contain within your firm-wide risk assessment. I think you can say currently we do not have any PEPs. However, we regularly, we will check all of our clients, and I know some of your systems do have alerts on them, so you would be highlighted to them. So no, I agree with your point, saying you are aware of the risks, but it's something you check.
Great. Another question we've had in, can the firm-wide risk assessment be drafted by a consultant and then reviewed and signed off by a relevant person? So Kathy, I'll come to you with this one.
Good question. I mean, there is nothing in the regulations which prohibits the use of a consultant or a third party, obviously. I would very much emphasise that it's the firm that best understands the firm's services, clients, risks and mitigations and the like. So the firm could pass the information on to the consultant. But in my view, I think it's likely to be more robust, or it's likely to be a more robust exercise if the firm takes ownership and carries out the assessment internally, just because they know their firm best. So essentially, while there's nothing wrong, in outsourcing the assessment, do bear in mind the risks of doing that is all I would say.
Great, thank you. So I think that's all we've got time for today. I'm sorry for those of you whose questions we did not get to address, but we will try and address those in future webinars. And in terms of the content of today's webinar and the resource pages, they will again be available on the events on demand page. And we'll try and cover off any other questions either by our Q&A page that we have on the website or through any future webinars. We hope you have found the content today helpful. We'd be really grateful if you could complete the link and on the evaluation link, below this video and let us know what you think. It's quite a short form and it shouldn't take longer than 2 minutes to complete, but it will really help us improve if we do receive that feedback for you. And you will also receive an email of the evaluation link today if you registered. Thanks again for your time today and goodbye.